Please confirm whether you can hear me, and equally whether my video and my sound is okay from your side. As you do that, make sure you have this particular question with you. The question for August 2024, which is question number 2, which is question number 2. Make sure you have that question with you. August 2024, question number 2. Yes, so this is the question I want us to start with. And I hope my video is clear. Our internet today is not that perfect. Okay. So first of all, we go through this question, we see what we are told, and equally what the examiner was requiring. We see what we are told. So the question is, Pata Limited, a quoted company which operates in agricultural sector, has investment in a number of companies. The following financial information related to Pata Limited and its investment companies. So we are given the statement of profit or loss and other comprehensive income, basically for 3 companies, Pata Limited, Soma Limited, and Jana Limited. Then down here, we have the extract of the equity section of the statement of financial position, equally for 3 companies, Pata, Soma, and Jana. Then we have some additional information, number 1, all the way to note number 7. Now, what are we required to do? Part A, we are required to calculate the value of the goodwill arising on acquisition of Soma Limited and also Jana Limited. And part B, we are required to prepare the consolidated statement of profit or loss and other comprehensive income for the year which ended 30th of June 2024. Now, what I want us to do, I want us to start with the part B, and then we finally compute the goodwill arising on what? On acquisition. And remember what we said is that once you come across this question for group accounts, the first thing you need to do is always to come up with a group structure. And then from there, you come up with a sketch of what you're required to prepare. You go through the additional information as you make the necessary consolidation adjustment. We said you should not start with the workings because those workings will just be consuming a lot of your time. And by the end of the day, we say they are not what? They are not marked. No marks which are allocated to them. So we need to come up with a group structure here. The group structure. So where do we have information about the group structure? Automatically, that one is not within paragraph 1. So that one should be from the additional information. Let's go to the additional information number 1. And we are told on 1st July 2021, Pata Limited acquired 75% of the ordinary shares of Soma Limited for a cash consideration of 4,500 million, when the retained earnings of Soma stood at 2,100 million. At the date of acquisition, okay, so I think we will go through that during the computation of goodwill. But basically what you're told in the first paragraph of note 1 is that the company called Pata Limited acquired 75% of the ordinary shares of the company, which is called Soma Limited, on 1st July 2021. 1st July 2021. Then we also given that other information in paragraph 1. We will come back there when computing maybe the goodwill and also preparing what is required in part B. Okay, then let's go to note number 2. And you're told on 1st January 2022, Pata Limited entered into a joint arrangement with another entity to establish a joint control over the net assets and the operations of Jana. So remember, a joint arrangement is whereby a company will acquire 50%. Is whereby the parent company will acquire 50% of the share. So we are told this company, that is Pata, entered into a joint arrangement, and that is specifically on 1st of January 2022, to establish a joint control over the operations of Jana Limited. So mean that this company acquired 50% of the shares issued by Jana Limited on which date? on 1st January 2022. 1st January 2022. So we have that information. And then can we first of all go to note number 3? In note number 3, we are told on 1st January 2024, Pata Limited acquired an additional 30% shareholding in Jana for a cash consideration of 500 million. So during the current year, that is on 1st January of 2024, we are told that this company acquired additional 30% of the share in Jana, meaning that this company therefore was able to acquire the control. So the control was basically acquired on that particular date. And therefore, if you can be able to recall what we said, is that in case of a piecemeal acquisition, because this is a piecemeal or stage acquisition, the parent company has acquired the control of Jana through several purchases of shares. We say that we compute the goodwill on the date the parent company acquired the control. So the goodwill in relation to this company will be computed on that date, the date the parent company was able to acquire the control. But basically, before we compute the goodwill as required in Part A and Part B, that is in Part A, Roman 1 and also Roman 2, first of all, I want us, we prepare what is required in Part B, and then we go back to Part A. So we said even in an examination set up, no problem with starting with Part B, provided your labeling is clear. The person who is marking your paper can be able to see that you started with Part B, and then you did Part A. You did Part A after Part B. So we start with Part A, that is Part B, whereby we are required to prepare the consolidated statement of a profit or loss, and other comprehensive incomes, which is for the year which ended 30th of June 2024, 30th of June 2024. And I hope you can also be able to see our figures there. They are given in million of shillings. So we just need to have a single column here. A single column, and our figures are in million of what? Of shillings. We said even before we proceed to prepare this, it is important for us to determine whether there was any company which was acquired during the current year. So like the first company here, that is Soma, you can see the date it was acquired. It was acquired back in 2021. So we are required to prepare this one for the year 2024. So automatically what that means is that we, when preparing our consolidated statement of profit or loss, we will take the revenue and expenses for this subsidiary for the whole year. For the whole what? Year. It was acquired back in 2021. The parent company had a control over this subsidiary for the full year. So, but now this one, that is Jana, you can see the parent company acquired the control on which date? This date here. That is 1st January 2024. The year is ending 30th of June 2024. So the year started here on 1st of July 2023. So how many months do we have here? Basically here we have 6 months, because we have July, August, September, October, November, and December. And then here we have 6 months. So here we have 6 months. Here we have 6 months. Now, in the first 6 months here, our parent company had a shareholding of what? In Jana. So our parent company, before acquiring this additional 30% of the shares, the parent company had what? 50% what? Shareholding. So if that is the case, then this company for the first 6 months, it was a joint arrangement, or basically it was a joint what? Venture. And then on this date, the parent company acquired an additional 30% shareholding, meaning that in the last 6 months, the parent company had 80% shareholding in what? In Jana, meaning that Jana for the last 6 months here, it was what? It was a subsidiary. It was what? A subsidiary. That information is very important when it comes to the preparation of our consolidated statement of profit or loss. So this can mean that in preparing this, we are going to take the revenue and expenses of the parent, that is Pata and Soma for the whole year, we combine them. And then for Jana, we will only take the revenue and expenses for 6 months, because it was only a subsidiary for 6 months. Then for the time it was a joint venture, we will compute something called the parent company share of the joint venture profit after tax. Sasa? Yes. So let's do that here. I want us to go back to the statement of profit or loss for individual company given below paragraph 1. And basically, we will start with the revenue. We will start with the revenue. So we take the revenue of the parent, which is part for the whole year, 7550. For this one, that is summer for the whole year, which is 4260. And then for this one, that is Jana, we will only take revenue for 6 months. It was a subsidiary only for 6 what? For 6 months. So we take half of that value. What is half of 2860? Half of 2860. Half of 2860 is what? Is 1430. Is 1430. And then we say, make sure this figure by the end of the day, you get it correct. Because we say the only adjustment affecting this is any sales between the parent and the subsidiary. So we will check whether we have that as we go through the additional information. Then from there, we have the cost of sales. We do the same. The full amount for the parent, that is Pata, Soma for the whole year, and basically for Jana, half. Half, that will be 740. Then from there, we will get the gross profit. We will get the gross profit. Now, before we proceed to less the expenses, remember, this particular company here, that is Jana, for the first 6 months, it was a joint venture. It was a joint venture. So what do we need to include here? As far as the joint venture is concerned, we need to include something called the group share. We add the group share of joint venture, or basically we can just refer to it as, yes, let's just refer to it as joint venture. Joint venture, profit after tax. So let's go to the income statement of this company here. From the income statement of Jana, how much was its profit for the year? The profit for the year for Jana from the income statement. Profit for the year for Jana, can you see that value? Yes, it is 500. So the first thing we need to do is, because this is the profit for the whole year, we want to compute the profit for the first 6 months, apportion that on time basis, and then get the parent company share of that. The parent company share will be 50%. 50%. So we get half of this, which is 250, and then half of 250 will be 125. Remember, you said these items do not have any adjustment. So having said, we can then proceed and realize the expenses. The first expense we have there is the distribution cost. And I hope you can always remember that this is a free mark in any question for group account. In any question for group account, this one do not have any adjustments. So we have 495 plus that of the subsidiary, that is Homa, which is 290, plus half that of Jana, which is 100. That one, we cross the bracket, and actually we take the figure to the last column here. So I'm told this will give us 885. 885. And take into account is an expense. Remember to record it here as a negative. This one is an income. We record it here as what? As a positive. Are you getting that value? 885. Are you getting 885? Maureen, are you getting 885? Faith, are you getting 885? Are you getting 885? 885, yes. Okay, so below that we have administrative expenses. The administrative expenses, we do the same. We take that of Pata 760, that of Jana 650, and half. Okay, that of Soma 650, and half that of Jana, which will be 200. So mostly we say that this one is adjusted with the amount of impairment loss. And then from there, we will get the profit from operations. And then to this, we less the finance cost. Finance cost, we do the same. We take that of the parent. 90, that is part of that of Soma 80, and half that of Jana, which is basically 30. So then from there, we will get the profit before what? Tax. And then to this, we less the income tax expense. Income tax expense is the other free mark here. So we take that of Pata, the 40, plus that of Soma, plus half that of Jana, which is basically 110. We close the bracket, we get the final value there. We get the final value. We get the final value there, which I'm told is what? Which I'm told is 820. 820. 820. Are you getting 820? 820. So that will be the profit after tax. The profit after tax. The profit after tax. The profit after tax. I need a confirmation whether that figure is correct. Are you getting a figure of 820? Okay, yes. So then below that, we add other comprehensive income, OCI. OCI, we have the gain on property devaluation. We have the gain on a property devaluation. So in this case, we should take that of the parent, which is 265. And then for the other company, that is Soma, equally for the whole what? For the whole year. That's that? Yes. And then for the other company, you can see that is Jana. That company is not having any devaluation reserve. So meaning that equally these one do not have any adjustment. In case you come across this, unless maybe you had a devaluation gain for this, that is the only revaluation gain which requires some working. But I think in our case, these two will not be having any working. So we just get the final figure of 340 what? 45. 345. So you can see basically that question, even without having dealt with the note, you should be able to get some free marks here. You should be able to get some free marks here. Some free marks there. Now, before we compute the goodwill, I want us to go through the additional information, and basically we see which items need to be adjusted here. We will start with note number 1. Let's go back to note number 1, additional information number 1, and specifically in additional information number 1, we go to paragraph 2. Paragraph 2. In paragraph 2, we are told at the date of acquisition, the fair value of the identifiable net asset approximated their carrying values with an exemption of an item of plant whose fair value exceeded the carrying amount by 600 million. So automatically that is a revaluation gain. That is a revaluation gain. That is a revaluation gain by which company? This is a revaluation gain by this company, because whatever you're given in note number 1 is about acquisition of Soma here. So Soma Limited, on the date of acquisition, it revalued the assets. There was a revaluation gain of how much? Of 600 million, because we are told the fair value of that asset exceeded the carrying amount. So 600 million is a revaluation what? A gain. So we are told the plant had a remaining useful economic life of how many years? 6 years. So who can tell us what do we need to compute as far as this revaluation gain is concerned? What do we need to compute here? As far as this revaluation gain is concerned, what do we need to compute? What do we need to compute? Specifically, I'm told by this, we need to compute depreciation. The specific name for that, once the subsidiary company revalues the asset on the date of acquisition, what do we compute? We compute something called what? The depreciation other charge. The depreciation what? Other charge. Depreciation other charge. So how do we compute the depreciation other charge? We take the revaluation gain, 600 million. We divide that with the remaining useful life. We are told there are 6 years. And then we multiply that with the proportion of time. Remember, in our case, what we said that when computing the depreciation other charge to be adjusted here, we compute the depreciation other charge for the current year only. So in our case, remember, this company was acquired like how many years back from this date? So, or basically, how many years do we have from the date this subsidiary was acquired? to the date of consolidation. So the first year ended 2022, 2023, 2024. So in this case, if, for example, we are preparing the consolidated statement of financial position, you multiply this with 3, such that you get depreciation under charge for 300 million. This one should be deducted from the PPE. But when preparing the consolidated statement of profit or loss, we only consider the depreciation under charge for the current year only. The depreciation under charge for the current year only is how much? Is 100 million. Is 100 what? Million. So what we consider here is depreciation under charge of 100 million. And what are we told there? Are we told how the company accounts for depreciation? No. In this case, we say this, the question is silent. Any depreciation under charge should be added here. Should be added to the group what? Cost of sales. Should be added to the group cost of sales. So we are done with that. So, but also remember, when computing the goodwill on acquisition of this subsidiary, this 600 million is a pre-acquisition revaluation reserve. So we're going to use it in the computation of what? Of the goodwill. When computing the goodwill, that will be one of the pre-acquisition revaluation reserve. Okay, so we have that. So then let's move to point number 2, and we are told on 1st January 2022, Pata Limited entered into a joint arrangement with another entity, to establish a joint control over the net assets and operations of Jana. Pata Limited acquired 50% of the ordinary shares of Jana Limited for a cash of 700 million when the retained earnings of Jana amounted to 1,300 million. Pata Limited equity accounted for its share of interest in Jana Limited in line with the International Accounting Standard number 28, investment in associate and joint venture. And then in note number 3, so as far as note number 2 is concerned, there is nothing which will be affecting our consolidation, or no a consolidation adjustment we need to make here as far as note number 2 is concerned. Sasa, what about note 3? We are told on 1st January 2024, Pata Limited acquired 30%, or that is additional 30% shareholding in Jana for a cash consideration of 500 million. The fair value of the original investment as at 1st January 2024 was 950. All that information, we are going to use it in the computation of goodwill arising on acquisition of this. So that information, we are going to use it in the computation of goodwill. And then you're told no fair value adjustment was necessary in respect of the identifiable net asset of whom? Of Jana. Sasa. So no consolidation adjustment we are going to make to this in relation to note number 3. In note number 4, you're told the group policy is to measure the non-controlling interest in subsidiary at their proportionate share of the net asset. So this is basically to guide us in terms of knowing which method to be used in the computation of goodwill. Automatically, we said, as per that note, we are going to compute the goodwill using the partial goodwill method. Number 5, we are told, during the year which ended 30th of June 2024, Pata Limited, which is our parent, sold some goods to Soma. Sold some goods to Soma Limited at for shilling 340 million fair value. So that is basically amount of intra-group trading. So that one should be deducted here, 340, and also should be deducted here. 340. And then you're told Pata Limited reported a loss of 550 million from this transaction. There is something we are going to change because I think there is some explanation which are given in relation to that note in our previous class. There is something we are going to change from that explanation which I gave. But maybe first of all, let's go through the entire statement, and then I'll be able to correct the explanation which I gave in our previous class. So we are told this company which sold the goods, that is Pata, reported a loss of 55 million on the transaction. 55 million on the transaction. Then you are told Soma Limited still had a half of these goods in its inventory at the end of the year. Now, if you can be able to recall what I said in our previous class, because this company sold some goods and basically made a loss of 55 million, I said that you need to compute something called the unrealized what? Loss, which we said should be half of this. Half of this, and I think that was coming to 27.5. Is that the position? Yes. But basically what you need to know is that if the parent company here sells some goods to the subsidiary, that is Soma, the goods were sold by this company at 340 million. 340 million. So this 340 to this company is basically a selling price. Is a selling price. If I sell some goods to you, maybe at 340 million, to me is a selling price. What about to you? That 340 will be what? In your books of account. Whenever you're recording that in your books of account, put that 340. Is it still a selling price? Or is cost? The 340 in your books of account, is it a selling price? Is it a cost? I've sold some goods to you, maybe having a value of 340 million. I'm saying in my books of account, that is a selling price. That is a selling what? Price. What about in your books of account? In your books of account is a cost. In your books of account, that is what? That is a cost. That is what? The cost. Now, if you can be able to remember now what you have been doing in all the other questions for group account, usually we come across questions whereby we compute the unrealized profit. And actually, I say that the implication of this unrealized profit is that it overstates the closing inventory of this. So if, for example, this company sold some goods now to this, and this company made a profit, we say that this unrealized profit usually overstates the closing inventory of this. Are we together? Yes. And that's why we say any unrealized profit should actually be deducted from the closing inventory, simply because the inventory of this company is actually overstated. Is actually what? Overstated. But now, if you come across this particular question, and basically you're told the selling company sold the asset or even some goods at a loss, sold the goods at a loss, the goods at what? The goods at a loss, then in this case, when preparing the group accounts, we always ignore that what? We ignore that loss. We ignore that what? Loss. In that case, we will not compute the unrealized what? Loss, like basically what I've explained in our previous class. Because if we do that, we will come and maybe adjust it in the closing inventory. And actually, you can see the closing inventory we have said is valued at cost. Is valued at what? At cost. But basically, let's not go into details about that. What you need to note that if we are told the goods or the selling company sold some goods and made a loss, so in that case, always ignore that particular word, loss. That's that. So you will only make an adjustment whereby the goods were sold at a profit. So if the goods were sold at a profit and some of the goods remain unsold at the end of the year, that is the only time you compute them, and it is what? A profit. And actually, we know that this profit, number one, we add it to the group cost of sales and we less it from the group inventory. But in case the goods were sold at a loss, that is something you need to note, was sold at a loss, basically ignore that loss. And I'll say that this is based on IS2, because if we will account for that particular unrealized loss, then the value for the closing inventory will be reduced below the cost, will be reduced below the cost. Remember, according to IS2, we should always value the inventory at the lower of the cost or the net realizable value. Sasa? Yes. So that loss, we ignore it. We do what? We ignore that loss. It will not be adjusted to the cost of sales. It will not be adjusted to the group inventory. In case we are to prepare the consolidated statement of financial position, we don't adjust that to the group inventory. Sasa? Yes, that note is important. So we are done with that. So and then number 6, we are told impairment review on 30th of June revealed that the goodwill on acquisition had not suffered any impairment. So we said if you come across that information, you need to come back here and you cross that bracket. No adjustment to the administrative expense, because usually we see that this one is adjusted with the impairment loss. So we can get the final values here. The final value will be how much? 7 what? 760 plus 650 plus 600 plus 200 plus 200. That will give us what? That will give us 16 what? 1610. And we said make sure you record that there as a negative. You record it there as what? As a negative, because that one is an expense. So, and then you are told number 7, all other incomes and expenses of the group are deemed to have accrued evenly throughout the year. So the reason why always you're given that information is for you to know that when taking or when computing the revenue and expenses of Jana for the last 6 months, when it was a subsidiary, you are basically going to apportion that on time basis. And that's specifically what you have done here. Is there anything which need to be adjusted here? I think no. So what we can do, let's get the final values, and then we go to the statement, or basically we go back to Roman 1 and we compute the goodwill on acquisition. So we start with the revenue. Give me the final value for the revenue. The final value for the revenue here. The final value for the revenue, I'm told by Gilbert, it is 13,100. What about the cost of sales? The cost of sales, 79 what? 30. 79.30. Is that what you're getting? 79.30. 79.30. Please confirm. $79.30. 79.30. Is that what you're getting? Confirm whether you're getting that values here. 79.30. Yes. Yes. Then in this case, we said, for example, if you're doing this question in an examination, I'll not even advise you to compute that one. You see that gross profit, we said by the end of the day that is not marked. Any figure which you get after adding or basically after deducting, do not have any mark. No mark for that. No mark for, no marks for that. No marks for that. For that there. Yes. So then from there, we have the final value for this one, the group share of joint venture profit after tax. We have the distribution. We have this profit of from operation. No need of even computing that. Can we get the finance cost? The finance cost is going to be 170, 200. Remember to record this as a negative. Remember to record it as a negative. To record it as a negative. Yes. So no need of computing this. No need of computing that. No need of computing that. No need of computing that. Now, if you do that question like that, you'll have gotten all the marks. For example, if you check, I was trying to check on the solution for this question here. If you check on how it was marked this particular question here, basically the marks are located. I don't know whether you can be able to see that. You can't be able to see that, but basically this is how the question was marked. Any 7 at 2, and you get 14 marks. The marks are located there were 14. You needed to get 7 items, 7 correct items, 7 correct items. You get the 14 what? Marks. That's why we say these particular items you get 3 marks. They are very important because you can see if you get this one correct, and even this one, because that one do not have any adjustment, distribution, and basically the income tax, you can see those are like 4 items. Those are like 4 items. You need to get 3 other items. So, and actually you can see also this one did not have any adjustment. The finance did not have any adjustment, including what? Including the administrative. Including the administrative what? Expense. You can see that is a question here, which was maybe quite simple. Even if, for example, maybe you adjusted this particular and there is loss, maybe you adjusted here. Equally, you can see maybe the only item which was long would have been long is this one. Sasa? Yes. So I think having that, I want us to go, we proceed and basically compute the goodwill on acquisition. The goodwill on acquisition, the goodwill on acquisition, goodwill on acquisition. And I want us to start by computing the goodwill on acquisition of this subsidiary here, that is Soma, goodwill on acquisition of Soma Limited. Soma Limited, the marks allocated there were 2. I think that one was quite simple. And remember, this goodwill will be computed using the partial. We are computing this using the partial goodwill method as per the information which are given in note number. As per the information you're given in note number 4, we are using the partial goodwill method. So how do we compute this? The goodwill using the partial goodwill method. We start with the purchase consideration paid by the parent. Purchase consideration, which was paid by the parent company. This one is in note number 1. Note number 1. Let's go to note number 1. Note number 1, we are told on 1st July 2021, Pata Limited acquired 75% of the ordinary shares of Soma for a cash consideration of 4,500 million. So the cash consideration paid by the parent was 45. So and then now to this, we do what? We less the fair value of net assets acquired. Fair value of net assets acquired. Now, how do we compute this one? We say to compute the fair value of the subsidiary company net asset on the date of acquisition, we take the subsidiary company ordinary share capital plus the pre-acquisition reserves. Now, where do we have the ordinary share capital? So below the information below paragraph 1, we have the statement of profit or loss, and then down there we have the extract of the equity section. So what are we interested with here? We're interested with the ordinary share capital of who? Of this subsidiary, that is Soma. So we go to the equity section of Soma Limited, and the first item we consider here is what? Is share capital. Share capital term, which is 500. So then below that we have the revaluation reserve. We have the revaluation reserve. The revaluation reserve. The revaluation reserve. So this revaluation reserve, we need to determine, is it pre or is it post? Is it pre or is it post? Based on the information which are given here. So that revaluation reserve by Jana, not Jana, sorry, by Soma. By Soma. It is also important for you to check the date. The date there. So that equity balances, they are at the end of the current year, on that year of June 2024. Now, what I'm asking, this revaluation reserve, which we are given here of 80, is it pre-acquisition? Is it post-acquisition? Who can tell us? I'm told by this is post-acquisition. Is this post or pre? Is this post or pre? And also take into account, can you go back to the income statement of Soma? In the income statement of Soma down there, we are also given other comprehensive income. We know that Soma during the current year revalued assets, and there was a gain on property revaluation of 80. So automatically that revaluation gain in the income statement of Soma is a revaluation gain which occurred during the current year. Remember when Soma was acquired? Soma was acquired 3 years back. So therefore, that revaluation reserve, is it a pre or post? A pre or post? A pre or post? Automatically, this one is post because it is for the current year. Since it's for the current year, yes, it is for the current year. That amount of 80, and actually it is the one which is in the income statement. It was for the current year. So that is a revaluation gain of Soma after it was acquired. Do we consider that here? No, because what we consider here is the ordinary share capital of this plus the pre-acquisition reserves. So that one will not be considered here. That one is a post. And then down there, we are given the retained profit brought forward and the profit for the year. I think for Soma, what we need to do, if you go back to the information we have in note number 1, we must be given its retained earnings on the date it was acquired. Yes, Abuja, we're going to consider that one in note number 1. I'm still where we have those the equity section. So we will go back to note 1. Sasa? Yes. So because that it has nothing to do with the revaluation gain we have in note number 1. Now I'm saying if you go to note number 1, you'll be able to see the first sentence or the first paragraph. We are given the retained earnings of Soma on the date it was acquired. Can you see the retained earnings of Soma on the date it was acquired? Because that's what we consider here. We consider the retained earnings of the subsidiary on the date it was acquired, on the date of acquisition. Can you see that amount? The amount of 21. Yes, that is basically what we consider here. That is what we consider here. The retained earnings on the date of acquisition. Automatically, the reason why given that breakdown, the retained earnings at the start, the retained earnings for the year or the profit for the year for us to be able to compute the retained earnings of Jana on this date. Sasa? Yes. So, but for Soma, we are given its retained earnings on the date it was acquired. So, do we have anything else to be considered here? Yes. We said always when computing this, we need to check whether the subsidiary company revalued the assets on the date of acquisition. If it revalued assets on the date of acquisition, any revaluation gain is considered here as part of pre-acquisition. And in note number 1, when Soma Limited was acquired, it revalued assets, and there was a revaluation gain in paragraph 2 of note 1 of 600 million. So that revaluation gain of 600 million, this one was not accounted for, and it is a pre-acquisition. It was not accounted for, and it is what? A pre-acquisition. I think that's basically what we have. I don't think we have any other component of our net assets. So what we need to do here is we get the total. So let's get the total here. Give me the total value. 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 What are you getting here as the total? What are you getting as the total here? What are you getting as the total? The total is basically 32. 32. So 32, we are using the partial goodwill method. So under the partial goodwill method, we're interested with the net asset of who? We're interested with the net assets acquired by who? By the parents. 75%. 75 what? Percent. 75%. So what will be 75% of 32? 75% of 32, it will give us what? It will give us 24. So we get the difference here, which now will be the goodwill, which will be the goodwill, and that is 21. Is it 21? Yes, 21. So basically that, what was the required here? And for example here, what is marked? What is marked here? What will be marked is this. By recording that cash consideration, you have a mark there. Recording this is a mark, that and that. That is basically what is marked. Let me see, for example, how many or how the marks were located here. How are the marks are located here? How the marks are located here? Yes, this is how it was marked. Any 2 at 1. If you get, for example, that cash consideration in the share capital, you already have the 2 marks with you. Sasa, it's not a must. You get the final figure correct there. You get the goodwill as you get this figure to be correct. So you just need to get 2 correct items. 2 correct words item. That and that will give you 2 marks. So let's move and compute the goodwill on acquisition of this other company. But now you need to note that the goodwill on the goodwill on acquisition of Jana, the computation of this is quite complex because we are computing the goodwill arising from piecemeal acquisition. The goodwill arising from piecemeal what? Acquisition. And actually, we say the computation of that is quite different. It's quite different from how we compute the other goodwill. So let's compute the goodwill on acquisition of Jana. On acquisition of Jana, I think I can have that working here. The goodwill on acquisition of Jana. On acquisition of who? Jana Limited. Remember this one, or basically this, the parent company acquired the control of Jana through several purchases of shares. So how do we compute the goodwill arising from piecemeal acquisition? We said always we start with the costs of additional investment, the cost of additional investment. Initially, the parent company had acquired 50% shareholding in Jana, and then later on acquired 30% shareholding. So this 30%, additional 30% which were acquired, we refer to that as what? Additional investment. So how much amount was paid? How much amount was paid? So we have that here. And then to this, we add the fair value of the original investment. The original investment is 50% shareholding. So what was its fair value on the date the parent company acquired the control? That is something always would be given. But equally, we said, if, for example, we were using the full goodwill method, we come and we add the NCI at fair value. We add the NCI at fair value in case we're using the full goodwill method. But remember here, we're using the partial goodwill method. So let's first of all, we record these two values, the cost of additional investment. So when the parent company acquired this additional 30% of the shares in Jana, how much amount was paid? That information we have it in note number 3. That information we have it in note number 3. That information we have it in note number 3. So the cost of additional investment, the cost of additional investment. The 30% shares were the parent company paid how much? Yes, in note number 3, you're told on 1st January 2024, Pata Limited acquired additional 30% shareholding in Jana for a cash consideration of 500 million. So that is the cost of the additional investment. Then in the same point, we are also given this one. So we are told that we are told the fair value of the original investment in Jana on 1st January 2024 was 950. So the fair value of the original investment was 950. Was 9 what? Was 950. Was 950. Now, but if you go back to the information, can we go back to the information which you're given in note number 2? In the information you're given in note number 2, you're told on 1st January 2022, Pata Limited entered into a joint arrangement with another entity to establish a joint control over the net asset and operations of Jana. And then you're told Pata Limited acquired 50% of the ordinary shares of Jana for a cash consideration of 700. So you can see this 50% shareholding, which was acquired back in 2022, was acquired at a cost of 700 million. So that is on 1st January 2022. But on this date, that is on 1st January 2024, the fair value of this, or basically this investment, was fair valued at how much? At 950. So it basically means that we have an increase in the fair value of this 50% investment. So how much is the increase here? How much is the increase in that? The increase in the value for that investment is basically 250. Now, how do we account for this? How do we account for that increase in the value of an investment in a company? So how do we account for that? How do we account for this? There is another question which we did similar to this one, and I was able to explain how we account for that. How do we account for this 250, which is the increase in the fair value of 50% shareholding in Jana? How do we account for this? Who can be able to remember? Who can be able to remember? Who can be able to remember? Who can be able to remember how we account for this 250? Who can be able to remember? Who can be able to remember how we account for this? Yes? Who can be able to remember? There is a similar question which we did, and I think I was able to explain how we account for this. Who can be able to remember how we account for this? Yes. So basically, this one we said that it should be recognized actually as part of OCI, as part of what? OCI. So maybe in that consolidated statement of profit or loss which you have prepared here, you basically recognize it as part of what? OCI, as part of what? OCI. So though that will not be affecting now this one. So can we first of all get the total here? This will give us a total of what? 1450, yeah? 1450. After adding those two values, again, are you getting 1450? 1450 EVS. Yes. So then now to this, what do we less? We less the fair value of our net assets, fair value of net assets, acquired, fair value of the net asset acquired. It's also important for you to remember we are computing the goodwill on acquisition of this subsidiary on this date. We compute the goodwill on the date the parent company acquired the control. That's why we are taking, for example, the amount which was paid on the parent, or basically the amount which was paid when the parent company was able to acquire the control, how much amount was paid for the additional 30% shares which were paid, and what was the fair value of the original investment on this date. We compute the goodwill on this date, the date the parent company acquired the control. So also it means that we are going to less the net assets which were acquired specifically on this date. So how do we compute the net asset of Jana Limited on this date? So we will take the ordinary share capital of Jana, and then we will add the pre-acquisition reserves, or basically the reserves which Jana Limited was having on that date. On that what? Date. So let's go to where we have the equity section of Jana. And the equity section of Jana is given below the statement of profit or loss. So the ordinary share capital of Jana is 300. 300. So Jana Limited do not have any devaluation reserve. I hope you can see that. So then in this case, we need to compute the retained earnings of Jana specifically on this date. That's why you can see in that case, we are given the retained earnings of Jana at the start of the year, that is brought forward, which is at the start, and also for the year. For you to be able to compute the retained earnings of Jana specifically on this date here. On that what? Date. So how do we compute the retained earnings of Jana on the date the parent company acquired control? So maybe you can have that here, because you're given the retained earnings brought forward. So the retained earnings brought forward is the retained earnings at the start of the year, and that is for 1450. So remember, you're interested with the retained earnings here. How do we compute the retained earnings here? Remember, you're given the profit for the year. The profit for this year is 500. Is 5 what? 500. So how do we compute the retained earnings of Jana specifically on this date? And that one is quite simple. We will take the retained earnings at the start, this one, 1450, and then to that we take the profit reported by Jana for the whole year. We basically compute how much profit was reported by Jana here before it was acquired. Remember, you have 6 months here, so we apportion that on time basis. We multiply that with 6 all over 12. So that will give us 1450 plus half of this, 250. That will give us what? That will give us 1700. 1700. Are you getting 1700? 1700. 1700. 1700. Are you getting 1700? Yes. So 1700. 1700. And maybe you can also check whether the subsidiary company devalued the assets on the date the parent company acquired the control. I think there is some information which are given in relation to that. In note number what? In note number 3, the last sentence, we are told no fair value adjustment were necessary in respect of identifiable net asset of Ghana. So when the parent company acquired the control, this company did not devalue the asset. That's that? Yes. So there was no revaluation gain. So we need to get the total, and basically this one will give us what? Will give us 2,000. Will give us 2,000. And because we are using the partial gooding method, we are interested with the net asset acquired by the parent. The net asset acquired by the parent will be 80%. Will be 80% this one. 80%. 80% of this will give us what? Will give us 1,600. Will give us 1,600. Will give us 16 what? 1,600. 1,600. So what we need to do is we get the difference. So this minus this one, and that will give us what? That will give us negative what? 150. Negative 150. What is the name given to that? What is the name given to that value of 150? That 150. The name given to that 150. Maureen. Faith. What is the name given to this? Mike. Patrice. The name given to this? Diana. Georgina. The name given to this? That negative 150. The name given to that figure here. That 150 is known as what? And I hope you can see the negative. Or we are wrong? No, we said whenever you're computing goodwill, you can get a positive figure, you can get a negative figure. We said if it's a positive figure, it's a goodwill. But if it's a negative figure, what is that? Yes, you can't remember the name? We say that if you get a negative figure here, this one is known as a gain on bargain purchase. A gain on bargain purchase. A gain on bargain purchase. Gain on bargain what? A purchase. And actually, we say that this gain on bargain purchase, we recognize it in the income statement as part of other income. So therefore, what you'll do from this consolidated statement of profit or loss which you have prepared, below the gross profit, can you include that gain? Can you include that gain on bargain purchase? Gain on bargain purchase. So this one we recognize it as part of the other incomes. An amount of how much? An amount of 150. An amount of what? 150. That's that? Yes. So if you get a negative figure down there, that one is a gain on bargain purchase. But if you get a positive figure, we say is what? Is a goodwill. Is what? Is a goodwill. So basically that is it, that what was required in that question. So what is marked here? What was marked there in relation to that Roman 2? So the items which were marked were this one, this, and that, and that. Yes. And basically, actually this one was, there are two marks for, two ticks for that because of this, because this was marked, there was a mark for that and this one, So, and any 4 at 1, any 4 at 1. So it basically means that it's not a must you get the final figure correct, provided you can be able to get that, and maybe some few items there. For every correct item which you get there is 1 mark. Is 1 what? 1 mark. So that is it. That basically what is required as far as that question is concerned. A very good question on a piecemeal acquisition. A very good question on piecemeal what? Acquisition. On a piecemeal acquisition. Okay, so I think we will take a short break. We will take a short break, and then once we come back, we look on something else. We look on something else after the break. After the break. Yes, so as we come back, can you have this question with you? This one, May 2021, which is question number 2. Not question 2, Lala, question 1. Question 1 is still a question on piecemeal, but let's look on that after the short break of just 5 minutes. 5 minutes, we come back. So we are told the following draft statement of financial position relates to P Limited, S Limited, and R Limited, all public companies as at 30th of June 2020. So we have the statement of financial position for P, S, and R, the non-current asset, current asset, equity, non-current liabilities, and current liabilities. We have additional information number 1 all the way to note number 6. So what are we required to do here? We are required to compute the goodwill on acquisition of S and also R. And then we are required to prepare the consolidated statement of financial position, consolidated statement of financial position. So the first thing we need to do here is basically to come up with a group structure. To come up with the group structure. So where do we have that information? The information is given in the additional information. So in note number 1, you're told on 1st July 2018, P Limited acquired ordinary shares of S Limited, or acquired 80% of the ordinary shares of S Limited. So this company, which is called P Limited, we are told acquired 80% of the ordinary shares of the company, which is called S Limited, on which date? On 1st July 2018. So this is the parent, this is a subsidiary. And then we also given other information here about the revaluation of assets. Maybe first of all, you can skip that. We go to note number 2. We are told on 1st July 2017, P Limited had acquired 5% of the ordinary shares of R and treated this as an investment at fair value through profit and loss in the financial statement. To that year of June 2019. On 1st January 2020, P Limited acquired a further 55% of the ordinary shares of R and gained a control. So this company initially had acquired 5% shareholding, and this 5% shareholding in R was acquired on which date? Was acquired on 1st July 2017. And then you're told later, that is on which date? On 1st January 2020. 1st January 2020, this company acquired a further 55% shareholding, and therefore it was able to acquire what? A control. Because you can see by the end of the day, P Limited will be having a total shareholding equivalent to 60%. So this is a piecemeal or a stage acquisition. Now, having said, what are we required to do here? Maybe start with part B before we come back to part A to compute the goodwill. In part B, we are required to prepare the consolidated statement of financial position of P Group. Now, we said in preparation of that, in preparation of the consolidated statement of financial position, because this one is prepared as at the end of the year, that is as at 30th of June 2020, 2020, we basically need to determine the status of S and R at the end of the year. So automatically this one will be a subsidiary at the end of the year, and equally this one will be a subsidiary, because you can see on this date, 1st January 2026 month to the end of the year, the parent company acquired the control. Still at the end of the year, this one will be a subsidiary. So if it is a subsidiary, it basically means that in preparing what is required in part B, we are going to combine similar items of assets and liabilities of all these companies, P, S, and also what? R. But it's also important, maybe, for example, if you're doing this question in an examination setup, it is important maybe you go through what you're given in note 2, note 3, and note 4. Although note 4, there was the aspect of impairment. There was the aspect of impairment of assets, but maybe if time allows, we are going to look on that. So let's go straight to that. We go straight to that. What is required in in part B? In part B of the question, first of all, we skip part A. So we are required to prepare the consolidated statement of financial position as at 30th of June 2020. And basically, I've said we will prepare this one by combining similar items of assets and liabilities for all our companies here. So let's go to the information we have below paragraph 1. And basically, we have the non-current asset. We will start with the PP. So PP, we combine for all the companies, 3920 plus 21 plus 910. We will see whether we have any adjustments. In addition to what you have below that, investment in S, investment in R, do we include that here? No. So instead, what we will do, we will compute the goodwill on acquisition of S and also the goodwill on acquisition of what? Of R. And basically recognize that here as what? As an asset. Then we have financial asset. Basically what we say is that also if you come across financial asset, in this question for group account, this one does not have any adjustment because financial asset is an investment in shares. So this one mostly will not be having an adjustment, but we will see as we go through the additional information. So we need to add the financial asset for all the companies. Then from there, below the current assets, or we go to the current assets, we have the inventories. Inventories, we have 315 plus 127 plus 218. So then below that, we have the trade receivables. We do the same, 170 plus 69 plus 118. And then we have cash and cash equivalents. So we have 120 plus 49 plus 84 plus 84. So then in that case, we should get the total assets. So then we proceed and record equity. We proceed and record equity. So at the equity, we have the ordinary share capital. And remember, in this case, we only record the ordinary share capital of the parent. And the ordinary share capital of the parent basically we know remain the same unless there was a share exchange consideration. But I think in this particular question, based on what we have in note number, I think note number 1 and also note number 2, I don't think we have any. We don't have any share exchange consideration, but basically we will be able to see as we go through the additional information. So in this case, we are only taking the ordinary share capital of the parent, the ordinary share capital of the parent. The ordinary share capital of the parent here is basically 1,000, is 1,000. So that one will only be adjusted in case we have a share exchange consideration. The same case with the share premium, that of the parent, which is basically 4,000. That is 400. The revaluation surplus, we will be able to see what you are told. We must be given information about the revaluation surplus for the subsidiaries. And then for the retained earnings, remember this is an item we should not compute. We get the total equity. Below the total equity, also there is something which should be computed and included here, known as the non-controlling interest. That is something we need to ignore, including what? The retained earnings. Below that, we have the non-current liabilities. Non-current liabilities, I can see we have 8% loan notes. So we add for the three companies, because these are items of liabilities, 17,500 plus what? Plus 475. Then below that, I can see we have deferred tax. So remember what we said, that anytime you come across a component of tax, like this one is a free mark. So because it's a component of tax, this one do not have any adjustment. We have 655, we have 200, and then we have what? We have 260. This one we can get the final figure, we take it to the last column. I'm told by Gilbert it would be 1175. So then from there we have the current liabilities. We do the same. We take the trade payables, and those of the parent, 570 plus 135 plus what? 45. We will check whether we have any amount of intercompany debt. Current tax, another free mark here. 575 plus 75 plus what? 25. No adjustment for that. Any component for tax, be it in the income statement, be it in the statement of financial position, no adjustment for this. That will give us what? 675. Yes. So we are done with coming up with a sketch. So what we need to do is we go through the additional information. We see, do we have any adjustment here? So now, let's go to note number 1. In note number 1, we are told that on 1st July 2018, that is in relation to the acquisition of this subsidiary, on 1st July 2018, P Limited acquired 80% of the ordinary shares of S. On this date, the fair value of identifiable net asset of S was shillings 2100 million. At the acquisition, the retained earnings and the revaluation surplus of S were 560 and 20 million respectively, and then no new shares which were issued. So if you take on what you're given in that point number 1, we are given the net asset. We are given the net asset of the fair value of net asset of S on the date of acquisition, because we are told on the date this company was acquired, the fair value of its net asset, that one was 21. And basically we know that this comprises of what? This comprises of the share capital plus pre-acquisition reserves. Pre-acquisition what? Reserves. So, and actually we are told in the same point there, on the date of acquisition, basically we are saying this one comprises of ordinary share capital plus the pre-acquisition reserves. Pre-acquisition reserves. Maybe first of all, we can take the ordinary share capital of this company. What is the ordinary share capital of S? We get that from the balance sheet of S at the equity. So in the balance sheet of S, its ordinary share capital is how much? Its ordinary share capital is 700. So which reserves was S Limited having on the date it was acquired? We have that in note 1. In note 1, sentence 2. At the acquisition, the retained earnings and the revaluation reserve of S were 560 and 20. So this is the retained earnings on the date of acquisition. This is the revaluation reserve on the date of acquisition. We are told no new shares have been issued. It basically means that the share capital of this company remains the same from the date it was acquired up to the current year. Up to the current what? Year. So why are we given this? If you go back to note number 1, sentence 2, we are told at this date, the fair value of identifiable net asset of S was 21. And I think, okay, note that point. I want us to go to the last sentence of note 1. Last sentence of note 1. We are told the excess of the fair value of the net asset is due to increase in the value of non-depreciable land. This company revalued land, but in that case, we are not given the revaluation gain. Automatically, the revaluation gain will be the difference between this and what we get here. So if you add this, the ordinary share capital of the subsidiary plus these two pre-acquisition reserves, that one will not give us 21. So first of all, after adding these three values, what are we going to get? That will give us 12 what? Will it give us 1280? This one will be, this will be 580. Plus that one will give us 1280. So meaning that there was a revaluation gain on land, which is equal to this one, which is 21 minus 1280. Minus 12 what? 80. And I hope there is nothing which you have omitted here. There is something you have omitted here. There is something you have omitted here, sorry. There is something you have not included here. If you go back to the balance sheet of S, specifically at the equity, I hope you can see we have share capital, and then we have the share premium. In this case, we said if you're given a share premium in the balance sheet of the subsidiary, unless told otherwise, that one is always taken to be pre-acquisition. So therefore, remember these are retained earnings, this is the revaluation reserve. We also need to include the share premium. The share premium is what? Is 100. Is 100. That one is a pre. That one is a pre-acquisition. So this one should give us 1380. 1380. Sasa is 1380. So what is the difference here? Yes, the difference is 720. So mean that the land was revalued upward with 720. So how do we account for this? This revaluation gain we added to the PP. Number two here, it is important for you to note that here we don't compute depreciation other charge, simply because we don't depreciate land. So we only compute depreciation other charge in case the asset which was revalued is a depreciable asset. Sasa? Yes. So the only adjustment which will be made is to add 722 and that value there to the PP. So number two, we're given some information about the acquisition of R. And I think in sentence one, we are told on 1st July 2017, P Limited acquired 5% of the ordinary shares in R and treated this as an investment at fair value through profit and loss. And then you're told on that year, on 1st January 2020, P Limited acquired a further 55% of the ordinary shares in R and therefore gained control. And then in the other paragraph there, we are told the consideration for the acquisition of shares in R was as follows. So we are given two dates, 1st July 2017 and 1st January 2017. So we are given the percentage shareholding. So because we know this 5% shareholding was acquired on 1st July, and then 55% was acquired on this date. So we are given a consideration. So the amount which was paid in acquiring 5% shares is 70 million. The amount paid in acquiring this is 560. And actually 560, that is now what we refer as the cost of additional investment. So when computing the goodwill, the cost of additional investment, the cost of this is 560 million. That one will be used in the computation of goodwill. And then you are told down here is at 1st January 2020, the fair value of 5% equity investment in R was 175. That is the fair value of the original investment. So then you're told the fair value of identifiable net asset of R on 1st January 2020, that is on this date, was 910, and the retained earnings stood at 520. The excess of the fair value of the net asset is due to an increase in the value of the plant with a remaining economic useful life of 4 years. So equally in that case, this company revalued assets. Are we given the revaluation gain? No. But basically, we are told the fair value of the net asset on this date was how much? Was basically 910. 910. This automatically comprises of ordinary share capital plus pre-acquisition what? Reserves. Plus pre-acquisition reserves. So what is the ordinary share capital of this company? That is R. The ordinary share capital of R from its balance sheet, ordinary share capital of R is 350. 3 what? 350. That is ordinary share capital of 𝐼𝐍. Is 𝐼𝐍 having any share premium? No. I'm getting that from the balance sheet of 𝐼𝐍. Is 𝐼𝐍 having any revaluation surplus? No. And then are we given the retained earnings of 𝐼𝐍 on the date of acquisition? I think yes. I think yes. In note number, that just before note number 3, we are told the retained earnings of 𝐼𝐍 stood at 520. On this date, the retained earnings of 𝐼𝐍 stood at 520. So the difference between what we get here and this amount here is due to revaluation of plant. Due to revaluation of a plant. So can we add these two values here? They'll give us what? They'll give us 870. 8 what? 70. So what is the difference between 870 and 910? And 910, will that give us 40? And I hope that retained earnings we are given, and the retained earnings stood at 520. 520, the share capital is 300. Yes. So that will give us what? 40, yeah? 40. So basically, that is the revaluation gain. This revaluation gain, we need to add it here. We need to add it here. And because whatever the revalued is planned, we also need to compute depreciation other charge. How do we compute the depreciation other charge for that plant? The depreciation other charge for that plant, we will take 40, we divide that with the remaining useful life. We are told the remaining useful life are 4 years. And then we multiply that with the proportion of time. Remember, we're interested with the depreciation other charge from this date. The asset was revalued on this date, 1st January, to the end of the year. And basically, we have 6 months. From this date, the parent company acquired the control to the date of consolidation. We have 6 months all over 12. So this will give us depreciation other charge of what? Of 5 million. That depreciation other charge of 5 million, we less it here. We less it there. We less it from the group what? PP. And then in note number 3, we are told that it is the group policy to measure and controlling interest at fair value. So we are going to compute the goodwill using the full goodwill method. And then you are told the fair value of the non-controlling interest in S, 525, and the fair value of the non-controlling interest in R, 315. That one will be used in the computation of a goodwill. Now, there is a note we are going to skip there because of time. I'll be able to show you this in our next class. So note 4. Note 4, what was being tested here is the concept of impairment loss. The concept of impairment loss, because of time, we can't be able to finish on that. I think that's what we will start with in our next class, because this one was on impairment of asset. Let's first of all, we skip that. And then we go to note 5. In note 5, we are told all goodwill arising on acquisitions have been tested for impairment and no impairment loss. And then you're told number 6, neither S nor R had issued new shares since the date of, or since P Limited acquired its shares in these two companies. So basically, in our case here, should we less 40 or add? That is a revaluation gain, Josina. 40 should be added because it's a revaluation gain. Since the revaluation gain, yes, that one should be added, just like what you have done to this 720, the revaluation gain on land. Yes, Georgina, that is very much correct. We added the revaluation gain with less depreciation at the charge. Is automatically a gain because you can see this one is giving us 870. So the difference. So remember, this is the carrying amount of the asset. So, and this is the fair value. The fair value is more than this. Is a gain. Is a gain. Is a gain we add. Is a gain we add. So I've said I will be able to show you. We are going to deal with the note 4 in our next class because of time. So it basically means that note number 4, because it's about impairment, automatically that one will affect this. So these other items basically will not have any adjustment. So what I want us to do, can we get the final values for these other items except PPE? So I want us to start with this financial asset. We have 315 plus 315 plus 210 plus 490. That will give us a final value of 1015. So here you can see we don't have any unreleased profit, no adjustment to inventory. 315 plus 127 plus 218. That will give us 660. No adjustment for receivables. We don't have any amount of intercompany debt. We have 170 plus 69 plus 118. 357. No cash in transit, no adjustment for this. We have 120 plus 49 plus 84, which will give us 253. No need of even adding the assets here. And then for the ordinary share capital, I hope you have seen, we don't have any form of share exchange here. There is no way we have a share exchange consideration. In acquisition of S, in acquisition of R, the parent company paid a cash consideration. So if that is the case, these two items, the share capital, the share premium, will not have any adjustment. Yes, I think for this one, equally the revaluation surplus, we can ignore that because it will be having some working. So this one, the 8% debentures on roll notes, not debentures, no adjustment. We cross the bracket, 17 plus 500 plus what? 475. We get 2675. So trade payables, no adjustment here. We have 570 plus 135 plus 45, which will give us what? 750, which will give us 7 what? 750, 750. Yes, so I think what we have. So what is the? I think what we have not been able to deal with is note 4, but basically we are going to deal with that note in our next class. I want us to compute now the goodwill on acquisition. Let's compute the goodwill on acquisition. And we will start by computing the goodwill on acquisition of who? Of the first subsidiary, that is 𝐻 Limited. Goodwill on acquisition of 𝐻 Limited. Remember, in this case, we are using the full goodwill method. We are using the full goodwill method based on the information we have, based on the information we have in note number, based on the information we have in note number 3. We are using the full goodwill method. Full goodwill method. So we need to have 2 columns here. So under the full goodwill method, we always start with the purchase consideration. The purchase consideration which was paid by the parent company. The purchase consideration paid by the parent company. The purchase consideration which the parent company paid is in note number 1. Let's go to note number 1. So on 1st July 2018, P Limited acquired 80% of the ordinary shares in S. Yes, automatically you're not given the purchase consideration there, but if you go to the balance sheet, the statement of financial position of S, specifically under the non-current assets, you can see the amount invested in S. The amount invested in S is the cash consideration, which is how much? Which is 1925. And because we're using the full goodwill method, to this we add the NCI at fair value. The NCI at fair value, we have this in note number 3. Note number 3, the NCI in S. NCI in S. NCI in S is 525,000. 525 what? 1,000. So we add the 2 values. We add the 2 values 0, 5, 4, 24 what? 50. 2450. So to this what do we less? To this we less the fair value of net assets acquired. Fair value of net assets acquired. So this, remember, is an we already given this value, no need of computing it. So when we have this value, we have this in note number 1. In note number 1 sentence, sentence 2, we are told on this date, that is on the date of acquisition, the fair value of identifiable net asset of S was 21. So this value is given 2100. And because we're using the full goodwill method, we take 100% of this. 100% of that, which is 21. So the goodwill on acquisition here, the goodwill on acquisition is what? 350. Was this goodwill impaired? No. As per the information we have in note number 5, all the goodwill arising on acquisition have been tested for impairment with no impairment loss. So no impairment loss here. So that is the goodwill which we are going to recognize here as basically a non-current asset. As a non-current what? Asset. So next, let's compute the goodwill on acquisition of 𝐷 Limited. Remember, 𝐷 Limited, the computation of this will be quite different because the parent company acquired the control of 𝐷 through several purchase of shares. So we have the aspect of piecemeal acquisition here. So how do we compute this one? We start with the cost of additional investment. The cost of additional investment. So the additional investment is 55% shareholding. So the 55% shareholding was acquired at a cost of what? That information, we have it in note number 2, below paragraph 2. So below paragraph 2, we are given the consideration for the acquisition of shares in 𝐷. So specifically, we're interested with the amount which was paid by the parent company in acquiring what? 55% shares, which was acquired on 1st January 2020. So the 55% shares, 55% shares, can you see the amount which was paid? Can you see that amount, Steve? Patrice, can you see that amount? Diana, can you see the amount which was paid by the parent company in acquiring 55% shareholding? Yes, that one is 560. That one is what? 560, the cost of additional investment. To this, we add the fair value of original investment. Fair value of original investment. The original investment is 5% shareholding. So that one is given within the last paragraph. In the last paragraph of note number 2. The last paragraph of note 2, we are told as at 1st January 2020, the fair value of 5% equity interest in 𝐷 was 175. That is the fair value of the original investment we added there. And because we are using the full goodwill method, to this we add the NCI at fair value. NCI at fair value, this one is in note number 3. The NCI at fair value in 𝐷 Limited, in note number 3, is 315. 315. 3 what? 15. So we add these 3 values, we get the total. We add those 3 values, we get the total, which is how much? Which is 10 what? 1050. Which is 10 what? 50. So after getting that, we need to move and basically be less the fair value of the net assets which were acquired. We less the fair value of net assets acquired. Fair value of the net asset acquired. Still, this one, we have it. We have this in the last sentence of note number 2. We are told as at 1st January 2020, the fair value of 5% equity interest in 𝐷 was 175. And then you're told the fair value of identifiable net asset of 𝐷 on 1st January 2020 was 910 million. So we are given the fair value of 𝐷 Limited net assets on the date the parent company acquired the control. Remember, the goodwill is computed on this date. So because you're using the full goodwill method, we take 100% of this. 100% of that is what? Is 910. And we less it from this value here. We less it from that value, and we get what? We get the goodwill. We get the goodwill. So how much is the goodwill on acquisition? The goodwill arising from the piecemeal or the stage acquisition is how much? Is 140. Is the goodwill impaired? Is the goodwill impaired? Our goodwill is not impaired as per the information we have in note number 5. So that goodwill we basically recognize it here as what? We recognize it there as a non-current asset. As a non-current what? Asset. That's how? Yes. So I think basically that's what is required. You can see these are a very good question, a very, very good question on a piecemeal. So what I'll be able to show you once we meet in our next class is note number 4. And basically I've said that will only affect PP because what was being examined in note 4 is on IS 36. IS 36, impairment of assets. Impairment of what? Of assets. I think we will look on that. Also, can you revise on disposal of interest? Disposal of interest. Disposal of interest. This is what we will revise once we meet in our next class. Yes, disposal of interest. Disposal of interest. So that now will be next week on Tuesday. Remember, we only have now 3 classes which are remaining. 3 classes which are remaining because our revision officially will be ending on Saturday. So therefore, make sure you have revised, I think, on 2 areas which are remaining. The disposal of interest and I think foreign subsidiary. I think that what will be revised on Tuesday and also Wednesday. That's Tuesday and Wednesday. So let's continue from there next week on Tuesday. So have a nice weekend. See you next week.